Good morning. Time to do what's up with the market. And why? Because what's the event? Well, new all-time highs have been made in the US market, have been achieved. And we're going to focus on that a bit and then just see what else is happening around the markets. So let's get into it. Before I do, as always, I have to tell you that none of this generic technical analysis that I do here is used in any of our trading products, our trading systems, Value Investor, Trader, and Income nor crypto. And I don't use any of this to make any decisions in the public portfolios, and nor do I use any of this to make any buy or sell decisions in my own personal portfolios, which obviously the public portfolios are too, or any others that I trade with. I'm a mechanical trader and have been for, I think it's measured in decades now. And I precisely follow my systems, our systems, Sherwell systems in my own personal trading, and you see those in the public portfolios. That's me, right? The other thing left to say is that everything we cover here today is general investment advice. There's no personal or direct investment advice in these sessions. With that said, let's get into it. Straight into the Dow Jones and the new all-time highs. Now, as most of you know, I show the resistance level, which now becomes a support level of the all-time high with these black rectangles and these blue others. These other blues are what were previous all-time highs and previously resistance, which now become support. And I typically do the top line over here at the highest close, so you won't see the close. It'll be blanked out by the black line. And I should tell you now that you can actually download these. You can import in the analyses manager. You can go into import over here, and you can import all of these analyses for yourself. For those of you that don't know, we don't remind you enough, and then you'll be able to see these exact charts in your own analyses. So what's happened here is we've had a new breakout to an all-time high, and that there was on the Dow Jones was a gap. It's a breakaway gap, and this is significant. And I'll just before anybody asks the question, tell you that we are still in a secular bull market, undoubtedly, because this doesn't happen in secular bull markets. You don't have breakaway gaps to new all-time highs. You don't have a breakout to a new all-time high there, run up, have a pretty severe, a pretty serious test of that all-time high breakout over there, and then bounce off it and go again, another leg up, and have a little bit of resistance at that leg over there. You can see it as the market gets indecision at new all-time highs, typically happened over there for a short period of time, broke out, came down, retested. This is classic bull market stuff. Primary bull market, secondary bull market, and secular bull market. Comes up again, gets tested, a little bit of a retracement, and this is relatively a very, 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 very short period of time, although there are a number of sleeps that we have while that happens. And of course, all the doomsayer news goes out all over the world, and there's plenty of it. You can make a list of 100 doomsayer things if you want to at any given time in the entire history of humankind, but we go and focus on that, and then what happens is a new all-time new high gets made with a breakaway gap, and we've had 4 or 5 days over here, a little bit of indecision, and importantly, that gap hasn't been filled yet. A little bit of a down day on the Dow Jones. That gap is still intact. Doesn't mean it's going to stay intact. If it doesn't get filled, doesn't get the vacuum, if you like, doesn't get filled, that would be an indication of more strength than if it did come all the way down and retest this previous resistance level, which is now a support level. And this is significant. It really, really is. I know that every single day doesn't feel like it. We've had 3 down days in the last 4. So people, will be thinking, oh, what's going on here? Because wow, as Daniel Kahneman and Amos Tversky told us, is we put at least twice as much energy and thought and feeling and emotion into negative things as what we do into positive things. And but this is going to be the theme of today's session, is these breakouts and to new all-time highs and what's going to happen from there. Other things to point out here is the Dow Jones in this period over here has been outperforming the S&P 500. So this is a relative strength comparison, basically a ratio between the Dow Jones and the S&P 500. And when the blue line's rising, it means the Dow Jones is outperforming the S&P 500, which typically happens when there's a little bit of disquiet happening in the market. In a raging bull market, we have the S&P 500 outperforming the Dow Jones, and we have the tech indices outperforming the S&P 500, which in turn is outperforming the Dow Jones. But the trends are still well and truly up. So let's move to the S&P 500, and we'll see here that that breakout also occurred there. Not a gap, not a breakaway gap, but there are the support and resistance levels, and there's the breakout, and now basically gone sideways for 4 days. Volatility is relatively low on the S&P 500, which is typically what you'll see in a rising market. So the S&P 500 confirming the Dow, which is the first step that you want to be happening in a bull market, particularly a breakout to a new all-time high. We look at the cumulative advanced decline line here, which is just measuring the number of stocks going up versus those going down on any given day on the New York Stock Exchange Index, which is 250 stocks. And we look for divergence. And this is a negative divergence. Of fact, we prefer the other way around, but this also will do where there's an advance. There are more stocks that are advancing than declining, but the index is having lower highs, and that led into a bit of weakness, which is typical divergence, if you like. And here we had it again, but it hasn't followed through. It's broken through here and gone to a new all-time high. So divergence doesn't always work, but we use it as a breadth of market indicator to give us any early insights of what may be happening in the market. Right, I skipped one over here. Oh, it's fine. It's not going to tell us the same thing. This is the number of stocks in the S&P 500 that are above the 150-day simple moving average. And again, we're looking for divergence here as well. You can look at all these instances where it didn't work, where there are a declining number of stocks above the 150-day moving averages, but the index is advancing. And those all failed. And we have a number, the number of stocks above the moving averages are rising here. We're sitting at about 70%, which we're not at all-time areas. We're not in an area where there is a massive, as a breadth of market indicator goes, an indicator of a massive amount of euphoria, if you like, in the market. And that typically happens when you get above that red line, and we are not above the red line at the moment. So this is pretty normal stuff for a primary and a secondary bull market. Okay, just moving on now to the indicator, which is the one that I put the most emphasis on, and that is the US dollar, and we're comparing it to the S&P 500. So what we're looking at here, the blue line is the S&P 500. This down here is the US dollar index, which is made up of 6 currencies around the world. And what we're looking for is relatively which one is stronger. Now, the 2 things we're looking at, one is we're looking at these going in opposite directions, which they spend a lot of their life doing, going in opposite directions. And typically when equities are rising, the US dollar falls, and vice versa. When the US dollar rises, equities fall. And where I've marked all these, you can see that they're going in opposite directions. So falling, rising, rising equities, falling US dollar, falling equities, rising US dollar, rising equities, falling US dollar, and so it goes. Now, they do sometimes go in the same direction, and so nothing happens 100% of the time. Probably in every single part of our lives, nothing happens, nor does it happen 0% of the time, but there's a high correlation, negative correlation between these 2 markets, US dollar index and equities. So what we do here is we got a relative strength comparison, which tries to give us, which is a ratio between the 2, and then we put a smooth index rate of change indicator on it. And effectively, when the CIROC is falling, that means that it's a risk on, it's positive for equities, and when the CIROC is rising, it's negative equities, because this Ciroc is really measuring the US dollar. And we've just got another signal over here where it's risen above. It's fallen below. So the blue line's fallen below the green line, and we've got a risk on over here, indicating there's weakness in the US dollar, which is turning into strength in the equities. So that wherever we see a green line on the right over here, for those of you that are relatively new to this, is that that is positive. That's risk on. So here the last one is a green line. So I'm looking at these indicators over here. So that's a risk on for equities. Now looking at the growth, Russell growth versus Russell value indices. Growth is the top, value is the bottom. You can see value is outperforming growth. So we want, and that's why this red line is the last line over here on the indicator. We've got a falling Ciroc, which is really measuring the relative strength as a ratio between value, between growth and value. And we see value outperforming. And in a raging bull market, we would have growth outperforming value. So that hasn't kicked in yet. And it is starting to get a bit oversold here, but this can stay oversold for quite long periods of time with growth underperforming value. So that's one sign, if you like, that's not in favor of a raging bull market about to happen. I do put more emphasis on the US dollar index, and also on the fact that we've had a raw price breakout on the indices carries more weight than that indicator, which is really more a sentiment indicator, as is this, measuring consumer discretionary versus consumer staples. Consumer staple at the bottom, consumer discretionary at the top. And this is also the last line, a red line here, declining Ciroc on the ratio. The relative strength ratio means that staples are a little bit stronger than what discretionary is. And we want discretionary to be doing much better than staples in a really strong bull market. So that hasn't kicked in yet, starting to get to oversold levels, but still could stay there for a while. And we haven't got this green line situation yet for that sentiment indicator. Another one, which is a bit of sentiment and a little bit of breadth of market, but mainly sentiment, is the put call ratios on all the stocks that make up the S&P 500 that are optionable, that do have options on them. And effectively, what this tells us is that when we got a 250-day, a year-long simple moving average on this, and then we put a Ciroc on the moving average. And it's a relatively sensitive Ciroc, so we can actually get some measurement on this, quite low volatility moving average, a year-long moving average. So the black line is the put-call ratio. We smooth the put-call ratio, and we put a smooth indicator on that. And effectively, when we have this green line, so when this starts falling, it means there are more calls going on than puts. So more puts going on means that there's a bit of bearish sentiment out there. More calls going on mean there's a bit more bullish sentiment happening out there. So we've just had that crossover over there, which means that calls and the put call ratio, there are more calls going into that are being bought than puts. So that's an early sign for risk on, for equities having a bit of a run. Of course, all this can change pretty quickly. We've got some, these are not intraday or by the day sentiment and breadth of market indicators we're looking on here. We're looking for longer type trends. Right. Next is interest rates, is treasuries. So this is a 10-year treasury bill, a treasury note, and you can see that the interest rates are rising. So this axis here is measuring yield, and it's been rising, and it's up into the 4.64. Same concept, relative strength line on the ratio between the S&P 500 and on yields. And we can see that this red line over here, meaning that yields are rising relative to equities. And that's not such a good thing, because as you know, as yields go up, interest rates go up, it has a bit of a pullback on equities, but equities are still rising despite that. So we're looking for a green line here where interest rates or bonds, treasury note yields start falling, and this trend does look up. So that's a little bit of a weakness against equities there. And the flip side of yields are bonds. So this is the 20-year treasury bond, which is TLT, which is actually an ETF, but tracker, if you like, tracks the corporate bonds. Sorry, not government bonds. And here you typically want bonds, and because bonds are the flip side of yields. And when yields are falling, then bonds are rising. Yields falling is good for equities. And so you typically do want to have equities and bonds going in the same direction. But happens very, very seldom. So, which is an indication, a bit of an insight into the fact that yields rising and having a negative effect on equities is not that strong a correlation. And as I've said before, I put more emphasis on the actual price action and also on on the US dollar index than I do on yields and bonds. So that's all the times that they go in opposite directions, and they should really be going in the same direction. But that said, bond prices are falling because yields are rising, but equities are still rising. This is the VIX, the volatility index, the fear index, if you like. Very low levels over here. You can see that I track these going a long way back. And there's the bottom, if you like, showing very low volatility. Markets tend to rise on low volatility and fall on high volatility. So all of these over here would correlate and align with severe bear markets. You can see that's 2007-8, and there's 2018. So we had very low levels, and this can change very, very quickly. But nothing to really see here that can tell us anything except the low volatility means it's risk on. Right, now we get to the Nasdaq composite, which is things get a bit more interesting here because we want to have the Dow Jones, the S&P 500, and the Nasdaq composite and Nasdaq 100 doing the same thing, and the follow through, and it typically happens in that order. Very seldom does the Nasdaq lead. That's typically the way that it's happening at the moment. So we're waiting for the Nasdaq to make a new all-time high, which it has not yet. Sure, we have a SPY 3 investor buy signal here on the index. We certainly are in a longer-term uptrend. We broke out of that. We had a breakout back here in April, found resistance, and now we're testing that resistance again. So this is really where we should be keeping an eye on to measure the strength of this breakout on the other two indices. We had the breakaway gap on the Dow, and which is still valid, that gap. And when we've got the breakout on the S&P 500 without a gap, and we haven't had a breakout yet on the Nasdaq, which is really what I'd like to see happen for a really good follow through into another leg up, that we would have something like that run up and put on a good few thousand points on the Nasdaq, and also even maybe a good many hundred or even more on the S&P 500. So measuring the relative strength, now we're measuring the Nasdaq versus the S&P 500, the more stable index. And here we have got a red line. So we are seeing this relative strength line here falling. So the declining blue line means that the Nasdaq is underperforming the S&P 500, which we can see with the naked eye, and really putting some order on this chart where we've got some support and resistance lines. We just haven't seen that breakout top right over here. So that's what we're going to keep an eye on. This doesn't have to go all the way, the smooth index rate of change doesn't have to go all the way down into the oversold zone here. It can turn midway. But let's have a look and see where that has happened. You can see there are plenty of instances where I've got lines on where it's turned midway as well. So that can happen, but let's keep an eye on the raw price action as well. Now to the Nasdaq 100, the similar thing. There's resistance now. It's well and truly above its previous breakout point. I haven't been talking about Fibonacci's at the moment, but the Fibonacci retracement on the leg up, the bull market run up to this point, this high over here, is still around about 23.6% retracement, which is strong. That's bullish. That it hasn't got down to a 38.2, and that's running from all the way back here in what are we at? April 2025. So this is a 16-month run up that I've got. So that's not short term, and to only have a 23.6% retracement on that is relatively shallow, despite what you may have read during all the time this happening about AI and you name it. There's so many things, wars and whatever, oil price and inflation. This is a relatively pretty shallow retracement that we've had. But this retracement's not over. It's only over when we make a new all-time high above this resistance zone over here. So underperforming the S&P 500, this tells us here, there's the declining blue relative strength line, the ratio, and we've also got the smooth index rate of change on that line showing that there's decline here. So we want to see green, this green line being the last line, if you like, when the Siroc crosses above its moving average is when we want to, that's what we want to see for a stronger bull market. Looking at the new high, new low, breadth of market measurement on the Nasdaq 100, you can see that's been rising. So that means there's been more 52-week new highs being made than 52-week new lows, but we've had a declining index. So that is divergence. And typically what follows that, not all the time, some of the time, is the falling market. And that did happen there. That's the Nasdaq 100, but it is recovering at the moment. And the Nasdaq 100 cumulative advanced decline line, again, measuring number of stocks advancing versus those declining in the Nasdaq 100. This is divergence. It's classic divergence. You can see that's what happened over there. Market rising, that's falling, and we actually had negative because this was falling, that fell. We've got the opposite over here where we've got falling index and rising advanced decline line. So let's see how this resolves as that breadth of market. This is the number of stocks above the 150-day moving average of the Nasdaq 100. And again, another breadth of market indicator. And this is showing strength, that there are more stocks that are above the 150-day moving average than not. Right, onto some of the other indices. This is the SOX, the Semiconductor Index. It made a new high up here as well. Now, it's had a deeper retracement. This is where a lot of the AI stocks and the tech stocks and whatever will reside in this index, the sub-index, if you like, or subset or sector. And it's had a deeper retracement. It's had a 38.2% retracement on the same measurement that I've got that I had on going back here to April 2025. So still 38.2 is telling you that relatively there's been more weakness in this sector than what there has been in the overall Nasdaq. And you can see outperformance there. One thing that is that is true in this is because it's been so strong up at 38.2, retracement is pretty normal, and it hasn't turned over the Siroc yet. So there's the last time that we got, if you like, and not a buy signal, but a confirmation that there's some potential strength in the market was this green line over here when the Siroc rose above. So this is saying that the semiconductor stocks, the AI stocks, the tech stocks are as a sector are outperforming their main index, the Nasdaq 100. So when we get this index outperforming the Nasdaq 100, the Nasdaq 100 outperforming the S&P 500, the S&P 500 outperforming the Dow Jones, that's when we have raging bull markets. So we've got early stages of that happening with the breakout on the two major indices, and these haven't quite followed yet. So I'm going to look elsewhere to see what the odds are of these following, so we do get those conditions of a raging bull market. And we'll step into that in a moment, and then we'll have a look at commodities. But let's have a look at some other indices. There's the All Ords. All Ords relatively has been outperforming the S&P 500, the SPX, just over this period of time here, by not going down by as much and then having some strength. And believe it or not, a new all-time high there on the 6th of August last week. We reached a new all-time high. How do I know that? I look at that previous high over there. So this is resistance, a couple of bashes at getting through it. And when was that? That was October last year. Another bash in February this year. Came down to support and now has risen again. And here we have a breakout to new all-time high. Testing it. And this is a very short period of time to test it. So it's going to be interesting to see for the breakouts on the indices we've seen, whether they retrace, whether they find support. And this breakout is very close, to the actual support now. And it can get lost a little bit in this range, if you like, or whether the All Ords continues up and breaks out into new territory and there's some strength. Right, so keep an eye on that one as well. Just looking at some other indices, this is and I'm only looking at these as a relative comparison to the All Ords and ready to point out how poor the All Ords has been. But this is the Toronto market, the Canadian market, and I've got this based back here to August last year. So this is a year long. So that's what's happened. That's what the Toronto Stock Exchange has done. The Canadian Stock Exchange has done. And I put a bit of a spine. So that's not a trend line that's matching peaks or troughs. It's a spine going through the middle. Really, if I took the spine correct, it should be. I've just stopped it at the latest high, but it'd probably end up being a little bit higher than that, showing that it's underneath its spine at the moment. And similarly with the All Ords, if I made this a spine, that this blue line would actually come down to here, indicating even more weakness relative to this line, which as a spine should probably go up to about there. But we're not doing that. We'll just take it to the nearest closes, and you can just tell by the gradient of those lines and where the price action is of the All Ords, the blue line over here, that we've underperformed. And the S&P and the Toronto Stock Exchange has also made a new all-time high as well. The Nikkei is looking, that black line is its last trough, which it found, its last peak, which it had found a lot of resistance around, going back all the way to 1989. So it's certainly in a strong trend, rising, outperforming the S&P 500. So Japanese stocks doing well. I brought a couple of other indices in here. I brought the Kospi in, the South Korean index, and why? Because we are doing research on the actual ETF that tracks this. And you may have read some news about it. It's made massive world headlines, and now people are talking about the weaknesses of leveraged ETFs and leverage in the market, and the typical stuff that you find when there's a bit of euphoria coming into the market. And all the doomsayers now have got some more bad news to talk about, and how this is going to undo the whole world, and et cetera, et cetera, et cetera. So we're going to keep an eye on the South Korean index, because it's got two really big AI type stocks in there, Samsung, and we're also going to keep an eye on the Taiwanese index as well, because of chip making, and so we'll have a look at that next. But interesting here, things to point out: massive rising volatility. So typically volatility, this is measured here with the ATRVE at the bottom over here. So often volatility is spoken about, and when markets fall, and in fact, it's almost become a synonym for falling markets. There's a lot of volatility around, and every now and then you see volatility on rising markets. Look at this volatility here, rising while the market was rising, and we're seeing this with some of the other ETF. We saw it in the SOX, the SOXL, which is the 3 times leveraged ETF that follows the SOX, the index, the Philly Semiconductor Index that we looked at just now. And here, look at this volatility for an index, up at 7%, up at 10% a bit earlier. So, this retracement was probably in store. There's the run-up going all the way, and it's had a 50% retracement, which is classic, technical analysis of over volatile markets to the upside. So let's see if it finds support here. It typically would, because this is still bull market territory, and we're in secular bull market, and there's still a lot of the story to play out on tech and AI and all that sort of thing. So let's keep an eye on this. Is one of the things. See if the 50% retracement holds, and if there's a bounce from here. A 61.8 on the amount of volatility it's had would be acceptable too, but you don't really want it to go below 61.8. And just look at how the 50% retracement and the 61.8 retracement are right near support and resistance zones. So let's keep an eye on the Kospi. And here is the Taiwanese index. It's had less of a retracement. It didn't get as volatile. It only got up to 3.5%, but still outperformed the S&P 500 as well. So we'll keep an eye on those two as proxy indices around the world, like the SOXs of tech, semiconductors, AI, and that whole story that's evolving. Okay, here we're looking at the FTSE 100, around about all-time highs, just snuck above over there of the all-time high, but now going sideways like the other markets. And look at this, it even outperformed the S&P 500 as it did over there, which has been very unusual for the FTSE 100 for some time. So that's near all-time highs as well. Okay, this is Chinese large cap stocks, not really going anywhere. It's a long way below. It's kind of been going sideways for many years. But let's have a look at the Shanghai All Share Index. That is starting to rise. It's showing it still sideways, but it looks like it's trying to break out of this long-term downtrend, which has been going for about nearly 20 years. And we do have the We do have the yin, which is the leveraged ETF in SPA3 income that we're tracking, but really Chinese markets are not doing that great. And we've also got the Hang Seng in here now because it has been showing some promise. Where is it? It also hasn't made a new high from also nearly 20 years ago. And but uptrend, broken out the uptrend, and we'll keep an eye on that as well, just as a proxy for Chinese stocks. The Australian dollar in a kind of a long-term, wide-ranging, upward trending trading band, but some weakness, and then a breakout of this channel, which has also brought a signal along as well. So the Australian dollar is probably, in that it's still relatively weak, or around about the midpoint where it should be. Around about the 70 mark is where traditionally it's been for many, many years, but in an uptrend at the moment, hasn't broken below the bottom. Okay, and one more index to look at, again, more just to show some weakness against Australia, is this is the South African market, as shown on the US, if you like. So on a unit for unit basis, even the South African market is outperforming the All Ords. Toronto's doing way better, Canada's doing way better, but here we have the South African market as well. So it's not just rugby; it's also the actual market too. So that's the spine, if you like, of both of the indices. And why have I compared them? Because Toronto, Australia, and South Africa are big resource markets, and that doesn't mean that they track each other exactly the same. There should be more correlation between the three of them, but there isn't. And in fact, I think the index that it broke on was the Bovespa because that's we won't go back there and test. We will have a look at the data and find out why. So that's the indices component. I'll quickly look at a few other indices on the US market. Then we'll look at commodities and we'll finish. So backing up what's happening with the Dow and the S&P 500, let's look at the S&P 500 equal weighted index, which effectively equal weights all 500 stocks across the board with the same market. So the S&P 500's market capitalization, which gets more weighting as a market capitalization index to the larger cap stocks and then less to the smaller cap. This one evenly distributes equal weights every single stock in the S&P 500, and that's had a breakout to a new all-time high as well. And this is showing risk on, which means it's outperforming, and I'll compare this to the S&P 500. So when we get equal weighted outperforming the S&P 500, that means the smaller cap stocks are doing just as well, if not better, than the larger cap stocks, which is a good thing, because we're talking, there's so much focus on AI and how much market cap is taken up by 7 or 10 stocks, and that they're the only ones that are pulling the market up. Well, that's not true, and you read that everywhere. I read a report just this week saying that, and henny penny, the sky's going to fall on our head because these large cap stocks are not doing well, and therefore, blah, 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 blah. It's not the case, and I'll show you some more evidence in a moment. So equal weighted, new all-time high, and it's actually showed a bit more strength in the last 3 or 4 trading days than what the indices, the market capitalization indices have themselves. So that's risk on. Let's have a look at the mid cap. This is the S&P 400, the next 400 stocks after the S&P 500 by market cap. Also, new all-time high. And outperforming the S&P 500, kind of matching a little bit of underperformance, the S&P 500, but still making a new all-time high, and was actually up in trading in the US session overnight, compared to the S&P 500 being down a smidgen. So this is also risk on. And let's have a look at the small cap index, the S&P 600, which are the next 600 after the 400, which is after the 500. So now we're looking at the bottom 600 of the top 1,500 stocks in the US market by market capitalization, breakout to new all-time high, and outperforming the S&P 500, the large cap. So don't believe everything you read in the newspapers or hear everywhere about these large cap stocks going to pull the whole index down, because there is opportunity. And here we are with, TNA has been the longest term trade we've had. It's been going for a little while now in SPA3 income. And I think it's sitting at, a good, healthy profit at the moment in that as a leveraged ETF, because this is the index that it follows, the small cap. And let's go one more. Sorry, we won't spend time on that. Let's go to the micro cap. So this is beyond the 500, the top 1,500 stocks. This is dollar Rumic. And guess what? there. It's right around. It hasn't made a new all-time high in the last week or two, but it is at all-time highs. Look at that. It was in the doldrums for a while, and it's had this fantastic run from April last year, to current, and it's hanging around its all-time highs as well. So this is typically what you'd see in a secular bull market. That's also a primary bull market. There's also a secondary bull market, is that you have even the micro caps doing well. So look at these charts as well. Don't just listen to, the top 7 or 10 stocks in the world are doing this, therefore. It's not always true. Okay, we'll quickly look at commodities. Start off with the CRB index, which is affected quite a lot by oil. It's not at its all-time highs. That happened back here in 2008 and even 2011, and had another good run. So we got above the 2011 commodity boom, that big boom we had back then. Been a bit of a run. That's not all oil related, that big run up over there, but testing these 2011 levels and going relatively strong. Gold, which is not in the CRB index, has been in the doldrums a little bit. Certainly in a longer term uptrend, but in a primary bull market, no, not quite a primary bull market. A little secondary bull market may have started over here. There's a breakout out of this downtrending channel here. Quite a few touches, 1, 2, 3, 4, 5, maybe 6 if you include that. So this is quite a significant breakout. Could be, you can see gold has underperformed equities, and a little bit of a breakout here. So let's see what happens at this resistance level, and if it runs all the way back to its previous all-time high and tests that resistance up there. Silver, while there's been weakness in gold, has underperformed gold during that period of time. I'm comparing it to gold here, and also broken the downtrending trend line. And we've had entry signals on UGL, Nugget, and on AGQ, the leveraged ETFs that follow gold and silver. Now, this is copper. Copper is at all-time highs. There it is. It's in an uptrend. This is relative to gold over here. I've got this measurement. Underperformed gold and is now just at the right-hand side of here. Started outperforming gold. Had a breakout to a new all-time high. And I think it's disappointing. I won't go into it now, but the small resources index has not reacted to the strength in gold. Typically, it does. That's what we saw back in 2002 and 2003. Running up to 2007-8, and then a big retracement. And again in 2011 was strength in copper is what really dragged up those stocks. We also had strength in nickel and zinc, and a bunch of stocks on the Australian market really took off. We're not seeing that at the moment, and there's a disconnect between copper and these small resource stocks, which usually dragged it along. That said, it doesn't mean it won't happen ever again, but there's the breakout. Come back into this right-on support, if you like. So we'll see where copper goes from here. Still worth keeping an eye on. This is oil. Oil is really dependent, so much correlated or affected so much by the war, and difficult to chart. It's going to go up and down based on that particular area that's happening with the Middle East. Right, Bitcoin, we'll just quickly go through Bitcoin. Bitcoin in a downtrend, undoubtedly. I still think that if it does stay true to its character and personality, it typically has 61.8 or 78.6% retracement. So it's got to the 61.8 and it's finding a little bit of support over here. And you can see there's a bit of support over there. I could actually raise this up here and have a look and see if that isn't a major support zone. It probably is more relevant. We'll do that. So that could be a support zone there. If it falls through here, it's probably going to go all the way to 78.6. And on this chart, if you go back and look, you'll see all of these Fibonacci retracements over here, which you can have a look at and see that a lot of them get to 78.6. So that could be where it's heading. And Ethereum is also in this downtrend. We could put a trend line on here and see if it's broken it. It's pretty much on it and deciding where to go. There is an open trade at the moment in SPA3 crypto. That's not a confident breakout yet, but it could be turning, or it could be following. If the breakdown happens on Bitcoin, then expect these to go as well. And this is Ripple. Ripple also in this downtrend, not an open trade, and also has big retracements. It's already gone past the 78.6 of that run up over there. The next support level is 88.6. So weakness in the crypto market, undoubtedly. Quickly, platinum has also retraced along with gold. Hasn't quite reversed yet. There's a bit of a U-bottom or a bit of a cup and handle forming over here, which is a turn, a reversal pattern that we'll wait and see. If gold goes, platinum's likely to go as well, as will palladium too. Right. So to finish on others, uranium in an uptrend. Lots of demand around the world. Iron ore is at this kind of band that it gets into between 95 and 110, and sometimes gets up to $120. And thermal coal also in this band, this level over here of in this range between 120 and 140. And I think lastly, no, nothing more to cover. Oh, might mention tins made a new all-time high. Right. Any questions? I'm going to go back to the S&P 500 and finish on that. And whoops, SPX. Okay, questions. So what else any news on the new signals you spoke of from Ralph? We're looking at, the research is still going. We're getting towards the pointy end now on the sparse income to add some more leveraged ETFs to that universe. And no more new signals, just some broadening the universe for sparse income. And then we'll get on to doing the same with sparse 3 investor. Bruce is asking any upcoming additions to the investor universe, stocks and ETFs. Sorry, yeah, just answered that for Ralph, Bruce. So that work's going on all the time, and it's it never ends. There's development happening, and there's also research happening. Okay, if there aren't any other questions, we'll finish it there, and we'll do another one of these when there's some kind of market event that happens that warrants some analysis. But at the moment, it's secular bull market's well and truly intact. I'm not going to do one of those until it, basically looking at the last one that's been out there for a year now, even more than a year, is still intact. When I think that's being threatened, I'll certainly do the analysis and everything, because it takes 2 or 3 days to get all that stuff done. And when it's relevant, we'll do it. And the same with these as well. We'll look at movements in the market where it warrants some serious analysis. Well, thank you for your time, and we'll be back then when that happens. In the meantime, I wish you consistent and objective and peaceful active investing and trading.